This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Walmart's woes. Red-hot online sales at the world's largest retailer are cooling off as e-commerce competition heats up. Odd couple. A supermarket chain is buying a drugstore chain, reminding investors just how quickly the retail and healthcare landscapes are changing. Corporate responsibility. Can the private sector do more to regulate gun sales than the government? Those stories and much more tonight on Nightly Business Report for this Tuesday, February the 20th. Good evening, everybody. I'm Bill Griffith. Tyler and Sue are both off tonight, and I'm here at the New York Stock Exchange, where stocks started this week with a sharp decline. And a big reason for that decline was Walmart. Shares of the world's largest retailer had one of their worst days ever today. Company did report earnings that missed analyst estimates, and on top of that, its online sales, which had been a big part of its growth story lately, they slowed. That's not something investors were expecting, especially during the critical holiday quarter. And so the stock was down more than 10% in today's trade. Courtney Reagan has more on what happened at Walmart.
The world's largest retailer has been on quite a run for some time, growing sales and its stock price. But investors aren't thrilled about the holiday quarter results. While the most recent quarter showed a continuation of strong total U.S. sales with 14 straight quarters of growth and positive in-store traffic, the discounter's profit forecast fell short of expectations, and online sales grew at the slowest pace in at least 5 quarters. Walmart says most of the e-commerce sales slowdown was expected because of the anniversary of the Jet.com acquisition. But there was also a hit from some inventory missteps during the holidays. CEO Doug McMillon explained further on an atypical live earnings call.
During the seasonal spikes, seasonal inventory, think electronics, toys, gifts, things like that, came into our fulfillment centers, and there was enough cube that it harmed our basic in-stock on more everyday items, and our basic in-stock for e-commerce suffered as a result.
While Walmart expects online sales to grow 40% this year, not all investors or analysts are convinced after growing at just 20% in the fourth quarter.
23% e-commerce growth is such a meaningful slowdown versus 50% just a quarter ago. I think that it's very difficult for investors to really get a handle on just how Walmart is going to very quickly reaccelerate that online growth.
And stores are still the cornerstone for Walmart. Online sales are still under 4% of total sales. Using stores and its website together is where Walmart shines over Amazon.
85% of the Walmart shoppers also shop at Amazon. So there really is a three-way boxing match between Amazon, Walmart, and Target. The Amazon rivalry will be a big multi-year story, and Walmart will use its stores, 4,800 stores, as fulfillment points.
At the end of the day, Walmart had a little stumble here, maybe lost the battle. I still think they're winning the war. They've added 65 million SKUs online since June of 16 when we upgraded the stock. Their prices are competitive, more competitive than Amazon, frankly.
And wars are long and costly endeavors. For Nightly Business Report, I'm Courtney Reagan.
So does Walmart still have momentum in e-commerce, and where does its stock go from here? Joining us tonight with her thoughts, industry expert Liz Dunn. She's the CEO of retail data company Proforma. Good to see you. Welcome back.
Great to see you, too.
$136 billion in revenue. They did 23% growth in e-commerce. Of course, the stock would go down 10%. No, you think it was overdone today?
I do think it was overdone. I mean, in isolation, the top line was great. The miss had some noise in the numbers. They definitely pulled some things forward to take advantage of the tax write-off that they'll get this fiscal year versus going forward. But I think overall, the sales number was quite strong. E-commerce was softer, and you can't ignore that. That's the thing that everyone's focused on.
That's the key component. Now, they want that their goal is to do 40% growth this year. Can they do it?
Well, I think that they will reaccelerate. I think that this was definitely a weak quarter, and they acknowledged that they made some missteps. They had some problems getting, their inventory in the right places and really investing in the key categories that were performing in those peak periods. And so that's a fixable issue. I think that they need to focus on growth more so than profitability for that online division, and that's something that it's been a line that they've had a little bit of trouble walking.
Now, as Courtney outlined there, on this online battle of the retail giants, you've got Walmart, you've got Amazon, of course, and Target. Who do you like?
Well, I actually think they're all three doing quite well. There's room for all
three to prosper?
I think there's room for all three to continue to grow double digits, and I think Amazon will probably outgrow the other two. But I think that what Walmart has, and what Target to a lesser degree, but Walmart really, I think, can benefit from their network of stores. So they really need to look for more and more ways to use those stores, and both Walmart and Target are looking for kind of same-day delivery options and all of the multi-channel things that you can bring in and bring the power of that store network to bear. So I think that the people that are going to get crushed the companies that are going to get crushed are those smaller companies that can't compete or can't find a competitive moat. I think that Walmart can compete well against Amazon. Certainly, this quarter they didn't do so well.
When you think about it, it's only been a year since Walmart bought Jet.com, the online upstart. They've made great strides in the last year in their e-commerce category, haven't they?
I've been really impressed with how innovative they've been in their thinking, and certainly bringing Mark Laurie and the Jet team on board has been one piece of that, or a big piece of that. One thing that we've heard a little bit of rumblings between the online and store divisions at Walmart. I don't think they need to be managing their business that way. I think they really need to be thinking about gaining share across all channels. And so, you look at a positive comp in this environment, that means that they are gaining share. I think that they need to do more to enhance their opportunities with the online business, and not think so much about cost containment, because really they need to invest to gain dominance, and I think that they're doing that.
Liz Dunn with Proforma, always good to see you. Thanks for joining us tonight.
Good to see you too.
You bet. As we said, the big decline in Walmart shares pulled the broader market lower today. The Dow fell for the first time in 7 trading sessions, and it hit some key technical levels during the day. A rise in Treasury yields also pressured stocks. The yield on the 10-year remained near a 4-year high. The 2-year actually hit close to a 10-year high today. Dow Jones Industrial Average, when all was said and done, fell by 254 points at the close to 24,964. The Nasdaq, which spent much of the day higher, finished down 5 points, and the S&P 500 was down nearly 16. Dow component Home Depot reported quarterly earnings and sales that topped Wall Street expectations. The world's largest home improvement retailer gave an upbeat forecast for the year and raised its quarterly dividend at the same time. The company was helped by a strengthening economy and a solid housing market, which has led consumers to spend more as well. And that helped Home Depot reach $100 billion in annual sales for the first time ever. Company's stock initially traded higher today, but then fell along with the rest of the market into the afternoon session. Qualcomm, meanwhile, sweetened its bid to acquire NXP Semiconductor to $44 billion. This new offer is Qualcomm's boldest move yet to fend off that $121 billion hostile bid from Broadcom. Following news of Qualcomm's sweetened offer for NXP, Broadcom said it was evaluating its options. Shares of NXP and Broadcom rose in trading today, while shares of Qualcomm were lower. And by the way, a shareholder advisory firm is recommending that Qualcomm shareholders vote for all 6 of the board candidates proposed by Broadcom. Glass Lewis says that Qualcomm's failure to achieve profitable growth and its recent disputes with regulators throw doubt on Qualcomm's business strategy, so it essentially is siding with Broadcom in this case. Investors were reminded today of the massive changes underway in the healthcare and consumer sectors when privately held supermarket chain Albertsons made an offer to buy the rest of the drugstore chain Rite Aid that is not already being sold to Walgreens. The move would create a supermarket and drugstore giant. It would allow Albertsons to go public in the future. The news sent shares of Rite Aid 3% higher today. Bertha Coombs is in New York with more on this unlikely get-together.
It is the latest odd bedfellows merger. Grocery chain Albertsons has agreed to acquire Rite Aid, adding to a privately held grocery conglomerate that includes Super Value, Safeway, and Jewel Osco. Executives say putting together grocery and pharmacy clinics could provide customers with a different kind of healthcare experience.
I think our opportunity to help people bring healthcare to life in terms of how we work directly with patients in our pharmacies and in our supermarkets could be very differentiating for us. And the ability to start to talk about, diet and nutrition as part of that interaction and have capabilities to bring to bear to help those patients, I think is very powerful.
It is a rapidly shifting retail and healthcare landscape. Pharmacy giant CVS's $69 billion deal to buy health insurer Aetna aims to create a drugstore clinic health system. Walgreens, after buying nearly half of Rite Aid stores, is reportedly exploring a deal to acquire drug distribution firm AmerisourceBergen to cut costs. And Amazon, launching a new healthcare firm with Berkshire Hathaway and JP Morgan.
We know that consumers, employers are they're dissatisfied with the healthcare system and the inefficiency of the healthcare system. And there are many deals that we're seeing, like CVS and Aetna, like Amazon, Berkshire Hathaway, and JP Morgan, that are looking to find ways to integrate and solve some of these healthcare issues.
These new retail pharmacy mergers aim to tackle what consumers want and need: lower costs and more on-site help managing their health.
Giving them convenience and choice is the key to creating the right kind of healthcare landscape.
For these would-be merger partners, the task will be to convince regulators that in a changing retail landscape where Amazon plays a bigger and bigger role, these unconventional mergers may be the best way to preserve consumer choice. For Nightly Business Report, I'm Bertha Coombs in New York.
Now to some of today's upgrades and downgrades. Snap saw its rating cut to an outright sell today from neutral at Citi. Citi saying that the negative reviews of Snapchat's recent redesign could result in a decline in user activity, which in turn could hit Snap's financial results. The price target was lowered to $14. Shares of Snap fell by 7% to $18.93. Meanwhile, Gap's rating was downgraded to sector weight from overweight at KeyBank. The firm citing the surprise departure of the head of the Gap brand. The analyst also points to concerns about the Gap brand's products, perception, and store fleet. The stock fell by 5% to $31.61. And Chipotle Mexican Grill saw its shares upgraded to hold from sell at Stifel today. The firm says that the new CEO there, who was hired away from Taco Bell last week, could provide Chipotle with a much-needed reboot. The analyst adds that there's now optimism over a potential pickup in traffic and margins. Shares rose nearly 4% at Chipotle today to $317.57. Still ahead, 3 big market calls on where stocks go from here. But there's virtually no agreement. A setback for AT&T in its legal fight against the government. A federal judge denied AT&T's request that it be allowed to see internal communications between the White House and government lawyers. AT&T believes that those communications would show that politics played a role in the government's decision to file a lawsuit against the company's $85 billion proposed merger with Time Warner. But the judge ruled that AT&T did not, in fact, show that it was singled out in the government's lawsuit. Shares of both AT&T and Time Warner fell in today's trading. And well, after weeks of stock market volatility, Wall Street is speaking up. A number of big firms are now issuing new forecasts for equities, and they don't all agree on what could happen next. Dominic Chu breaks it down for us tonight.
Just when it looked like everything was being constructive and the stock market was going to recover from those recent sell-off lows, you get a day like what we had today, and the market's kind of taken a turn for the worse. So it puts to light, again, this idea of a bull-bear debate and whether or not there is a reason to still remain constructive and positive on the overall stock market. Well, a number of different strategists and experts on Wall Street have now weighed in, given the recent market volatility, and some of the more bullish calls have come out of shops like BlackRock, the biggest asset manager out there, a lot of exchange-traded funds. The folks at BlackRock, the strategist team, say that fiscal stimulus is supercharging U.S. profit growth expectations and that those positive effects are being underappreciated by the markets overall. They're very bullish on stocks, especially in the U.S. They've upgraded them, so BlackRock on the bullish side of things. Goldman Sachs and the analyst and strategist team there think that most corrections don't involve recession or bear market, like what we've seen so far, that recent pullback. Positive returns typically follow in the months after that, so 3, 6, 12 months later. Goldman Sachs fairly constructive, more bullish on the overall picture for stocks as well. And then there's Morgan Stanley. Some of the analysts and strategists there feel as though we may be due for more selling pressure. They say that the recent pullback that we've seen is the appetizer and not the main course, meaning one, if not several, 10% pullbacks in the market could happen in 2018. So a bull case, bear case, a lot of debate right now over whether or not we could see the market direction shift for the overall stock picture. For Nightly Business Report, I'm Dominic Chu.
By the way, to read more about the different forecasts for stocks, you can head to our website at nbr.com. See if you can make sense of it all. BHP Billiton delivers a rise in profits, and that's where we begin tonight's market focus. The world's largest miner reported a 25% gain in first-half earnings thanks to higher commodity prices. BHP plans to focus on cutting debt and increasing shareholder returns, and today it did just that. It raised its dividend to 55 cents a share, but shares themselves fell by 4% to $46.55. Theme park operator Six Flags reported better than expected earnings, even as poor weather during the period caused attendance to slip. The company's CEO said that he's happy with Six Flags' performance and optimistic about the stock's upward potential.
We registered our 8th straight record year, and the fourth quarter was the biggest fourth quarter in our history, with revenue up 7% and EBITDA up 16%. So while the stock is down, I have to tell you that today I've taken the opportunity to spend $9 million to acquire about 160,000 Six Flags shares via our stock option programs.
Shares of Six Flags, by the way, fell more than 4.5% today to close at $66.18. Newspaper publisher Gannett reported a quarterly loss and a drop in sales. That company warned that it's continuing to face declining print ad revenues and circulation revenues. It also said that it does not expect that to change anytime soon. That's what's going on in newspapers right now. Shares of Gannett were down 11% today to $9.97. And despite reporting profits that topped expectations, Domino's Pizza served up disappointing sales growth in the latest quarter. Same-store sales at the pizza chain lagged expectations, fueling concerns of potential weakness in the future. And separately, this is intriguing, it was reported that Burger King owner Restaurant Brands was preparing a bid for Domino's. Domino's stock rose fractionally today to $221.49. And technology company Ubiquity Networks has disclosed that the SEC has requested documents relating to the company's accounting and international trade practices. Ubiquity said that it is working to respond to the SEC requests. The firm was recently targeted by known short seller Citron Research, which accused the tech company of fraud. The stock lost a quarter of its value, dropping 25% today to $55.28. And there's been a lot of talk recently about gun sales in this country. A column in today's New York Times folds in a new idea that puts the private sector at the center of the story. Our Andrew Ross Sorkin looks at how banks could play a role in gun sales if Washington won't. He writes that banks and credit card companies could restrict sales of assault weapons by simply refusing to do business with retailers that sell those types of weapons. Joining us to talk about that and whether big business can indeed be a catalyst for change in this gun sales debate, brand expert Dean Crutchfield is with us tonight. He's founder of brand advisory firm Dean Crutchfield Company. Dean, good to see you. Welcome tonight.
Great. Thanks for inviting me on the show.
You bet. What do you think of Andrew's idea? Overall, that the private sector could have a role in the whole gun sales debate right now.
Yeah, I think it's huge. I mean, look, matters are clearly the division of deep regret, but, you know, we have a situation on our hands here where it's really not about the why anymore of doing it. It's about the moment and what you do in that moment. And the government has basically been sitting there for far too long to be any good. So really, it's up to the private sector, it's up to brands to lead that way and support the public in making changes that are necessary. So that's really a clear opportunity for brands to play. And the fact that Apple Pay and PayPal and Square have all come out with decisions saying they will not do business with those types of businesses is a big statement. And the beauty is that means they've opened the gates. Now let's see what comes through.
I wonder, though, and I worry about the possibility that this represents restraint of trade.
I agree with you. I agree with you.
What role do they have in keeping people from being able to buy a gun, you know, whether we agree with the whole idea of gun regulations or not? But what about the idea that it's restraint of trade?
Well, I think businesses make decisions every day about things they want to do and things they don't want to do, and it's the same for guns. Right. So I don't think it's a restriction of trade, depending on how they go about it. It's a business decision. It's basically saying my business, my brand doesn't do that business. So that's a simple decision to make. I think there will be issues, there will be legal debates, but I think ultimately businesses make these decisions every day about who they want to do business with.
I mean, the whole point is that maybe it is the free market that can come up with a solution that we face in this country, which we all know something needs to be done about it, where regulations out of Congress have failed to this point.
Yeah, well, brands, you know, we trust brands more than we trust institutions and the government. I mean, a lot. You know, brands do some stupid things sometimes, we've seen that, but typically we do trust them a lot. So we want their involvement. I think that we've seen so many movements, so many marches, so many demonstrations, and ultimately they've all become submerged. So I think here's an opportunity right now, in this moment, for big brands to get on the street with the public to show you that there's some things that need to change and they need to happen now. And if you look today at President Trump, he threw some sops our way about bump stocks. I mean, bump stocks was Las Vegas. That was ages ago. What about now? It seems that everything's dragging on. So I think retailers, brands, PayPals, those kind of prolific frontier brands coming in to help the cause will really kind of smash open the gates to make change a reality.
Dean Crutchfield of the Dean Crutchfield Company. Good to see you again, Dean. Thanks for joining us tonight. And coming up, why the debate over hiking the gas tax is hitting a roadblock. General Electric is said to be considering a sale of its gas engine business. This according to Reuters. The unit could be worth as much as $2 billion. Such a sale would help streamline GE's power division, which saw its profits plunge by 45% last year. Earlier this year, as you may know, GE CEO John Flannery signaled that he is open to a more far-reaching breakup of that company. Customer satisfaction in the airline industry dipped even as a record number of people took flights. The annual Air Travelers in America survey found that 81% of those questioned were satisfied with their overall experience last year, but that's down from 85% in 2016. The survey of more than 5,000 travelers comes after a year when the airline industry was hit with several high-profile incidents where passengers clashed with flight crews. As we reported last week, there's talk in Washington lately of hiking the federal gas tax to help pay for needed infrastructure repairs. But a new report shows just how much that would hit drivers in some states, and that's not going over very well. Yilan Mui has the latest for us tonight from Washington.
The drive to raise the federal gas tax hitting a roadblock in Washington. A new report out today projects increasing the gas tax by just a quarter would translate into hundreds of dollars in new costs for consumers every year. $220 in Rhode Island, $300 in Minnesota, up to $390 in Mississippi. The data comes from Freedom Partners, the conservative group leading the charge against raising the gas tax, especially on the heels of Republicans sweeping tax cuts.
It's the wrong course of action to give long-needed tax relief to Americans and then claw back nearly a quarter of that in the form of raising taxes at the gas pump.
The federal gas tax is currently 18.4 cents a gallon, and that money goes into the National Highway Trust Fund. It helps pay for repairs to roads and bridges. But the gas tax hasn't been raised since 1993, leaving the government in a cash crunch. Now, President Trump is reportedly willing to consider an increase to pay for his big infrastructure plan. One key congressman, Republican Bill Schuster, chairman of the Transportation Committee, says he is on board.
It's efficient, it's understandable, and it's a fee, it's a tax, we collect that goes 100% to its intended purpose, and that's the highway system, the transit system in this country.
Also backing the idea, the U.S. Chamber of Commerce. It's the one proposing that 25-cent hike in the gas tax and letting it rise with inflation after that. It says that's fundamentally good for business.
American business relies on our nation's infrastructure to move their product to market, to move our employees to and from work, and to provide a quality of life for all Americans.
No matter what happens here in Washington, you could still wind up paying more when you fill up your tank. 7 states raised their gas tax last year, and several more are considering it this year. So there's still plenty of fuel left in this fight. For Nightly Business Report, I'm Milan Mui in Washington.
As expected, Black Panther had a very strong showing at the box office over the weekend. The movie pulled in more than $240 million over the President's Day weekend, one of the biggest openings ever. Before we go, here's another look at the stock slide on Wall Street today. When all was said and done, the Dow fell 254 points, closed at 24,964. The NASDAQ was down by 5 after spending much of the day higher, and the S&P down nearly 16 points today. That is the Nightly Business Report for tonight. I'm Bill Griffith. Thanks so much for joining us. Have a great evening. See you tomorrow.